I am Power SS SGM College Carriage. Today we have learned partnership final account. Partnership final account is the last step of accounting procedure. So firstly we have see the accounting procedure. In accounting procedure, first journal or subsidiary books. Journal means all financial transactions are recorded in first books is called as journal. In small scale organizations, they are used one book or maintenance record in one book is called as journal. But in big scale organizations, there are more transactions. So they maintain recorded in separate books. So these records called as subsidiary books. Then journal transactions posted to related accounts is called as ledger. Then all accounts are closed. Find out some account shows credit balance and some account shows debit balance, and these balances transfer to trial balance. Trial balance means a list of ledger balances is called as trial balance. In trial balance, two types of income and expenditure are involved. First, capital income and expenditure. Capital income and expenditure means which expenditure is a non-recurring nature. That is, expenditure incurred any one time but get a benefit more than years is called as capital expenditure. And second, revenue expenditure. And income. Revenue expenditure and income means which expenditure is recurring in nature. For example, expenditure incurred day to day, weekly, monthly, quarterly is called as revenue income and expenditure. In revenue expenditure, there are two types. First, direct income and expenditure. Direct income and expenditure means a expenditure related to production, related to factory is called as direct income and expenditure. And second, indirect income and expenditure. Indirect income and expenditure means which expenses related to office expenses, related to selling expenses, related to administration expenses is called as indirect income and expenditure. This capital expenditure, direct expenditure and indirect expenditure, we have stated the following example. For example, we have started the business made for a duster. These organizations required first capital, then furniture, building, machinery, then required raw material, for example wood, sponge or gum is called as goods. Then in that factory appointed any workers, so paid remuneration is called as wages. Then raw material bring in company or factory, there are paid traveling expenses is called as carriage. And then in factory used motive power, lighting, coal, gas, etc. In this stage, the product is made, then this product sold in the market. In that step, some expenditure are incurred. For example, traveling, then We have take a office for rent, then appointed staff, so they pay remuneration, salary, advertisement, commission, discount, insurance, etc. These expenditures are incurred to the made for a duster. For example, capital furniture, it is invested into one time but get a benefit more than years, is called as a capital expenditure. Then which expenditure is related to production or related factory is called as direct expenditure, this. And then which expenditure related to selling expenses, office expenses and administration expenses is called as indirect expenditure. These expenditure are transferred to the trial balance. Trial balance prepared in two format: journal format and ledger format. In journal format, there are three columns: particular, debit balances and credit balances, and in ledger format, there are four columns. In left hand side, two columns: particular and debit balances, and in right hand side, particular and credit balances. Then trial balance transactions are posted to the related statement. For example, trading account, profit or loss account and balance sheet. Three statements are prepared in final account. It is the last step of accounting procedure. So direct income and expenditure transferred to trading account, indirect income and expenditure transferred to profit or loss account, and capital income and expenditure transferred to the balance sheet. In trial balance, given income and expenditure, there are given only one effect: if trading account, profit or loss account or balance sheet. Some additional information given in our problem. Additional information means which expenditure could not recorded in the books of account. For example, outstanding expenses, prepaid expenses, depreciation. These are not recorded in the books of account. So this additional information given in our problem. So these adjustments given minimum 2 effects and maximum 3 or 4 effects. Some adjustments: first effect goes to trading or profit or loss account, and second effect goes to balance sheet. For example, depreciation. First effect goes to balance sheet and second effect goes to trading or profit or loss account. Some adjustment given effect only accounts, do not goes to the balance sheet. For example, goods distributed as pre-sample. This first effect goes to trading account and second effect goes to profit or loss account, not to a balance sheet. And some adjustments effects goes to only balance sheet, not a trading or profit or loss account. For example, bills receivable is a dishonor, bills payable is a dishonor. Both the effects goes to the balance sheet, not to trading and profit or loss account. In our syllabus, one adjustment, there are 3 effects. For example, goods sold, goods are destroyed by fire of rupees 10,000, and insurance company admitted a claim of rupees 8,000. It is insured goods. These adjustments go 3 effects goes to first effect in trading account, second effect in profit or loss account, and third effect in balance sheet. So total good started by fire rupees 10,000. It is the credit side of trading account 10,000. Then insurance company admitted a claim of rupees 8,000. This goes to balance sheet in asset side 8,000, and difference between that amount rupees 2,000, it is actual loss. So this effect goes to the profit or loss account. So only one adjustments in our syllabus, there are 3 effects. Remaining adjustments minimum 2 effects. Then some important concept we have seen. For example, purchase return. Purchase return. It is also called as return outward. Return outward. Purchase return or return outward, if any goods damaged in transit or defective goods, they are returned to suppliers or returned by the customers. So these goods are amount less from purchase. Then sales return. Sales return, it is also called as return inward. Return inward. This amount deducted from the sales, but sometime purchase return or sales return given in our trial balance only the word return, and journal specimen is given and amount in debit column and credit column. So which is amount purchase return and which is amount sales return, it is identified is most important. So which amount is given in debit column, which amount is given in debit column, it is a sales return, less from sales, and which is amount in given credit column, it is a purchase return, this amount less from purchase. Then next concept, carriage inward and carriage outward. Carriage inward and carriage outward. Carriage inward means when organizations purchase raw material, bring in factory, that time pay traveling expenses is called as carriage inward. It is a direct expenditure. So this expenditure transfer to trading account. And ready-made product sold in the market, that time which expenditure is paid or traveling expenditure is called as carriage outward. It is related to selling expenses. So these are transferred to profit or loss account. So return inward, return outward, and carriage inward and carriage outward. It is a different expenditure. So transfer, so related account. Then trade expenses. Trade expenses. In our trial balance, some expenditure are given. For example, trade expenses, sundry expenses, general expenses, miscellaneous expenses, other expenses. These expenditure given in our trial balance. In that case, trade expenses, it is a transfer to trading account, and remaining expenditure, it is a indirect expenditure, so it is transferred to profit or loss account. If all the expenditure given in our trial balance, so trade expenses transferred to trading account and remaining expenditure transferred to profit or loss account. But sometimes only trade expenses is given. Only trade expense is given, remaining expenditure is not given. In that case, trade expenses transferred to profit or loss account. Transferred to profit or loss account. Then another important concept, wages. Wages is a direct expenditure. If any worker appointed in factory, so they are paid any remuneration. is called as wages. It is a direct expenditure recorded in trading account. And then salary. It is office staff. When you are appointed office staff and they pay remuneration is called as salary. It is a transfer to profit or loss account. So wages is a direct expenditure and salary it is a indirect expenditure. But sometimes the wages and salary given in our trial balance together. For example, wages and salary or salary and wages. In this case, which word is given first? So depend direct expenditure or indirect expenditure. In first is wages and salary. So wages is a given first. So it is a direct expenditure recorded in trading account. And in here salary is a first. It is indirect expenditure. So this amount or this expenditure transferred to the profit or loss account. Then all trial balances and adjustments given transfer to the related statement. For example, trading account, they are divided into two sides. Left hand side is a debit, right hand side is a credit. All expenditure are recorded in debit side, all incomes are recorded in credit side. Then profit or loss account, this account divided into two sides, left hand side and right hand side. Left hand side is called as debit, right hand side is called as credit. In left hand side or debit side all expenditure are recorded, and in credit side all incomes are recorded. And balance sheet. Balance is divided into two sides. Left hand side is called as liabilities and right hand side is called as assets. These three statements involved in final account. So all trial balance expenditure are recorded in trading account, profit or loss account and balance sheet. For example, in trading account debit side 1000, 2000, 5000, these are expenditure recorded, and in credit side 10,000, these amount are recorded. Firstly, take a total in both sides. So debit side total is 8,000 and the total of credit side it is 10,000. In this case, which is excess amount is taken in both sides. In this case, 10,000 is excess amount. So 10,000 amount taken both sides. 10,000 and find out balancing figure. In this case, the balancing figure is 2,000. When credit side is excess over than debit side is called as profit, and when debit side is excess over than credit side is called as loss. In this case, the credit side is excess over than debit side, so 2,000 is a profit, is called as gross profit. The result of trading account, gross profit or gross loss. In this case, to get the amount 2,000 is a gross profit. Then the amount of gross profit is transferred to profit or loss account. If profit recorded in credit side, if a loss recorded in debit side. So these are recorded in credit side by gross profit 2,000. Then close profit and loss account. Some expenditure in debit side, for example 500, 600, 400. So these amount are recorded in debit side and 2,000. Same process to the closing accounts. First take a debit side total, it is a 2,000. The total of debit side it is a 1,600 and total of credit side it is a 2,000. In this case, the credit side is excess over than debit side. So amount of 2,000 taken both sides, 2,000 Then find out balancing figure. In this case, the balancing figure is 4,000. When credit side is excess over than debit side is called as net profit, and when debit side is excess over than credit side is called as net loss. In this case, the 2000 is the excess amount of credit side, so balancing figure is called as net profit. Net profit. Then, if you are prepared capital or current account, capital or current account, for example, there are two partners A and B. In this case, the amount of net profit distributed among the partners, the amount of profit or loss distributed in their profit sharing ratio. If profit sharing ratio is not given, in that case this amount distributed among the partners in equal or in capital ratio. So here not a profit sharing ratio given, so the amount of profit distributed equal among the partners 200 and 200. Then close the capital or current account. If the result of capital or current account is a credit balance, so recorded in liability side, and if it shows the debit balance recorded in asset side. If capital or current account is not given, so amount of net profit transfer to a balance sheet. If net profit add in capital, or if net loss deduct from capital, then some amounts in liability side and some amount in asset side. When I take a total of both sides, so these total are equal. If any all transactions of trial balance and adjustments given correctly paid, so balance sheet is automatically tally. The total of both sides is equal. Today we have seen the how to prepare final account. In next lecture we have studied about the practical problem of final account. Thank you.